Hello, in this lecture we're going to talk about the definition of objectivity. According to Fundamental Accounting Principles, WOW 22nd edition, the definition of objectivity is concept that prescribes independent, unbiased evidence to support financial statement information. Some key terms here are that in terms of accounting, we are generally looking at objectivity in terms of the financial statement information, meaning we want that financial statement information to be meaningful. In order to do that, we do emphasize the idea of independence, because independence leads towards that unbiased opinion that we're looking for, which is another key term here. We want an unbiased opinion about those financial statements because that unbiased opinion can give us more reliability about the financial statements. So here's what we're looking at. We're looking at the financial statements. We want those financial statements to be as dependable and reliable as possible. How do we do that within the profession? There's a couple tools that can be used within the profession in order to apply the concept of objectivity to the financial statements. One is a profession in and of itself. So the profession includes a CPA license, so that will regulate the profession of accounting. That's one way to regulate the profession of accounting, is to require some type of certification, some kind of task that must be achieved in order to get a minimum amount of knowledge in order to achieve the CPA license, and some type of internal regulation within the accounting field through that process. We also have rules in terms of the creation of the financial statements, especially for publicly traded companies, have to have some type of regulations that need to be abided by in order to put together the financial statements in accordance with a certain set of rules and regulations. We could also have external audits. So again, especially with publicly traded companies, we are required to have external audits. That brings in the concept of independence, meaning that we might have accountants within the company creating the financial statements, but we want to have someone outside, another CPA firm outside the company, review, audit the financial statements, and that gives an added layer of that independence when reviewing whether or not these financial statements are presented fairly in accordance with generally accepted accounting principles.